So before we get into this lesson, we need to understand the basics of market structure. Here you have your swing high, and here you have your swing low. Now we have another swing that took out our previous swing high, which would be our higher high. But when can we identify our new low? When price takes out our higher high. So once price takes out our higher high, we can identify the swing that formed that expansion as our new higher low, and so on, so on. Price came back into the range, forming our higher high, took out our higher high, forming our higher low. So let's take a look at a chart example. Price is on a bullish trend, and you can see a reversal, forming your lower high and a lower low, lower high, lower low, so on, so on. So as far as the basics goes, now we need to identify the operating range. So here you have a swing high. Now you have a swing low. These two lines, in between those two lines, this is your operating range. So when price comes back, you would say price came back into the range. So the range is basically the price point where price is looking for an inefficiency. So if you're looking for a buy or a sell, it would more than likely occur in your range. And this is how you can keep track on price movement. So now this is your new swing. Price broke that swing, formed your low. So now this is your new range, and so on, so on. So here's an example of locating ranges. You have your swing low formed. Now you have your swing high. So now you have your range. Price came back into the range, forming a new range. So let's go over this easy way to locate ranges in case you're still confused. So let's say you have your swing high. Now you have your swing low, and this is your high. So let's say you break this high. Once you break this high, now you can say this is your swing low, and this is your swing high. So this would be the range. So now when price gets back into your range, now you're looking for an inefficiency. So now you can say price is operating in your range. So let's say price consolidates for a little bit and then takes out this swing high. So where is your new range? Your new range is this swing low. Why is it this swing low? Because this swing low right here is responsible for taking out this high, which is the high of your range. So now this is your range. So now when price comes back and comes back into the range, then takes out your newer higher high, where would be your range? It would be this swing low that forced this break and the higher high that got broken. So now this is your range. So that's all it is. Look at it as a zigzag. In, out, in, out, in, out. So why are ranges important? Institutions buy and sell price inside of these ranges. So when you find a range, this is where institutions are going to conduct business. So think about it as simple as this. Let's say in the middle of this range, you can purchase price for $5, of course, hypothetically. If you purchase price somewhere here, you can purchase it for $2. If you purchase price here, you can purchase price for $7. So the institutions are making a decision. At what point do they want to buy price? Do they want to buy price when it reaches this level and expand from here? Or do they want to purchase price at the $5 mark and expand from there? Or do they want to wait all the way till it's the cheapest to purchase price from here? And this is the information the range provides you. So what can you do to identify these price points? What you could do is you could break your swing low and your swing high into 4 sectors. So the distance between your swing low and your swing high into 4 portions. And you can do that with the Fibonacci. And the settings for the Fibonacci is 0 to 100 broken into 4. So this would be 0, this would be 25, this would be 50, this would be 75, and this would be 100. It's simple. And this level, which would be the extreme of your range, would be your discounted price. In the middle here, like we said previously, the $5, this would be your fair price. So when price comes here and reacts, you can say price reacted from your fair price. And when it comes all the way down here, it reacted from your discount. And a lot of times it's safest to anticipate a reaction from the cheapest price point, which would be purchasing at discount. But sometimes price doesn't reach all the way down here. So you would have to anticipate a fair price. So let's go over the characteristics when price consolidates. Here you have your range. You have your swing high and your swing low. And here you have your discounted level. And here you have your premium level. So let's say price reacts from the premium. What happens when price reacts from premium? You would expect price to continue dropping lower. But price doesn't drop lower. It reacts from your discount. So now you know price is in a consolidation. That means price is ranging. The institutions are accumulating orders. And you will see a continuous bounce between these two levels for a while until price picks a direction to break out in. So as you can see, price formed your range, your high and your low, and price is consolidating in between the range, rejecting from your extremes. Again, if you take a closer look, after price formed the range, it reacted from the extremes. And the reason why price reacted from the extremes is because price reacted from your premium and discount levels and stayed within those ranges until it decided breaking out of a specific direction. So now that you have a better understanding of ranges, let's get into market profile. So we have two types of profiles. We're going to start off with the supply and demand profile. This would be categorized as a demand profile. Why would this be our demand profile? And of course, inverted would be supply. So this would be our demand because price is currently moving from our demand zones. As you can see, price is moving from our demand zones. It broke through the range, came back, took out our high, took out the liquidity here, formed a peak, came back, and seeked internal liquidity. So anything inside of the range would be your internal liquidity. So it will always be your demand. So as price continues, you would want to be looking for price to reverse in your demand area to continue high. So a supply and demand market profile doesn't have to be in the extreme. So it doesn't only have to react from your extremes. It can also move like this. So what makes this a supply and demand profile? Price is breaking highs and comes back inside of the range. As long as it comes back inside of the range and identifies internal liquidity, which would be internal liquidity is inside of the range, external liquidity is outside of the range. So as long as price always seeking internal liquidity, this is a supply and demand profile. Price broke this high, came back inside of the range. Same here, broke, came back inside of the range. So this would be your supply and demand profile. So the other type of market profile we're going to learn about today is your support and resistance profile. Why is this called our support and resistance profile? Because price is reacting from your support and resistance levels. Price is not seeking internal liquidity inside of these ranges. Price is not pulling back all the way down here. Price is reacting from external liquidity. So this would be your support and resistance profile. So here's an example of support and resistance market profile. So here you have your swing high, and here you have your swing low. What did price do? Price broke down, reacted from your support and resistance, and came down. What happened after then? Formed your high, and it formed your low. Price broke out, reacted from your support and resistance without closing inside of the range, and dropped down. What happened next? This is your high, and this is your low. Price broke down, reacted from your support and resistance, and broke down, and so on, so on. So here we have an example of supply and demand profile. So here you have your swing. So this would have been your range, and price broke structure, closed above, and then came back inside of the range. So then what happened next? Now this is your low, and that previous swing is your high. Price broke structure and then came back inside of the range. So later finish above the high. Here you had price break structure, came back inside of the range, and then expanded again. After that, you had a swing high and a swing low. Price broke above and then came inside of the range to capture liquidity and continue higher. So as a bonus lesson, let's include the fractal nature of the market. Here you have your swing high and your swing low, and consider this on the macro, so on your higher time frame. So while this is occurring on your macro time frame, which is just a swing high and a swing low, on a micro time frame, there's consecutive swings, a sequence of complex pullbacks, this forming this micro swing high and swing low. So here we have a rejection that formed a swing low. So this is on the macro time frame, which is the higher time frames. So look at this reaction on the micro, which is the lower time frames. On the micro time frame, you start seeing details. You start seeing the profile shifts. And that's what we mean by fractal. What occurs on the higher time frame occurs on the lower time frame, and vice versa. And what you need to notice is price shifting profiles. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, and comment. Let me know if you guys want an advanced version of this lesson.